When I worked at Amazon, I practiced one of the core ways of working that Bezos had set for the company, and that was working backwards, meaning you went out, talked to customers, and built things that you knew they wanted rather than forcing a product or service on them. Nike just reported their quarterly earnings, and I was pleased to see Elliot Hill doing exactly this in their running department, where they're working to regain market share. Here are a couple of other game notes from the earnings call. Nike had a relatively strong quarter, coming in with $11.72 billion in revenue, 6.5% greater than the 11% Wall Street expected. They also beat on earnings per share, coming in with 49 cents versus the 27 cents expected. Their running business surged 20% in the quarter, and North America saw the biggest impact from working backwards and the win now strategy I talked about in the earnings preview. They also launched a new strategy called Sport Offense. This means they're aggressively leaning into sports footwear and apparel versus lifestyle. This also allows Nike to restructure their teams internally to be a bit more agile, as different sports are at different stages of the win now comeback plan. Let's see what else they have in the pipe though. Nike has some really exciting opportunities in the mix, including promotion around the World Cup 2026, a successful launch of their partnership with the Kardashian Skims brand, successful athlete endorsements across golf, tennis, and global football, and lastly, the resurgence amongst wholesalers like Amazon, where they're already outperforming. On the downside, sales in China are down 10%, and it's going to take more time and investment to fully rebuild there. Their stores business is also hurting, but as part of the Sport Offense plan, they're going to revamp the store experience to focus entirely around sports. And lastly, and this is a big one, tariffs. Previously reported $1 billion hit to the business. That number has been updated to $1.5 billion. The stock has settled into about a 5% bump since beating on earnings, but it's still down 11% over the last 12 months. Meanwhile, the Dow is up 11% over the same period. And if you know Nike, you know the downside is far greater if you look at the big picture. Lastly, Wall Street's opinion. Morgan Stanley thinks Nike might be a buy low opportunity, assuming they can do a couple of things, and that is stabilize sales, relaunch new and exciting products, and recapture consumer buzz. At the same time, if consumer demand stays soft, tariffs continue to eat into their margins, and they fail to win back the excitement from younger consumers, the recovery might take longer or be weaker than expected. Thanks guys, keep us posted on your thoughts when it comes to Nike. Be good.